Hello, everyone. I am Fyruz Khan, and today this is my last class for the day. I'm back with a brand new class and really exciting stuff. I hope you guys are doing well. Um, so let's wait for some students to join. In the meantime, if you haven't liked our Facebook page, please go and like it. Just type in Fyruz Education Services. You can also subscribe to our YouTube channel. Again, just type in Fyruz Education Services. We have around 40 videos, live classes of business studies, IELTS. You can also send us requests so that we can make better lessons for you. Okay, so we'll wait for some students to join, and then we'll go forward with the class. Yeah, today we have something really exciting. So as you can see on the screen, this is a room. Now, this is a room where I've spent around 6 to 7 years. It's not here in Bangladesh. It's in Leicester, UK. That's the place I completed my bachelor's and master's from. As you can see, this room is quite basic because I was a student. I didn't have much money back then, or I was quite cautious of my cash flow, right? Um, so it has a simple bed, some family pictures here, friends, mom, and a random poster, some random posters again some pictures here. This couch here was literally collected from a street beside our house. It was for free. I never wanted to spend extra money on furnitures because, as I told you, I was a student. I had to be really aware of my cash flow, right? Why? Because cash flow is important because there are two things which are important in cash flow: cash inflow. So my income was not so much. Okay, that's why I had to cut my expenses, right? So my cash inflow, which was earning, I used to work in restaurants and different places. My earning was not so much. So this is why the outflow, when your earning is not so much, your expenses needs to be less. Always your inflow, your earning needs to be more than your outflow. Okay. If it's the opposite, let's say if you spend more than what you're earning, then you will have cash flow problems. So, I had a very basic room, basic bed, and this curtain was, I bought it from Amazon only for £10. So everything was quite basic because I wasn't earning so much, and I was always cautious and scared of overspending. So I always kept a positive cash flow. My earning was more than my expenses. Okay, you can earn 100,000, you can earn, let's say, 1 crore taka, and you can also overspend. You can also earn just 30,000 taka and not overspend and have a positive cash flow. So your earning needs to be more, your inflow needs to be more than outflow. Keep that in mind. And sharing this room with you has been quite nostalgic. It's my favorite room. And having said that, I've spent many nights studying in this bed. And one subject I hated was accounting. Whenever you look at a statement like this, especially in my case, I used to be scared. It used to give me chills, right? But then I've made it very simple for you. Now, since we're talking about cash flow forecast shows you how much you've earned and spent over a period of time. And it's a forecast. You're assuming what's going to happen in the future. You're assuming what is going to happen next year, January, next year, February, next year, March, April, May, June, so forth. So it's a forecast, right? You are forecasting the future. Um, yeah. Why are you forecasting the future? Because you're forecasting because you want to plan ahead, right? Now, in a cash flow forecast, it has 5 sections. Very easy. You have inflows, you have outflows, total inflows. Inflows means earnings, outflows means expenses, And then when you minus them, you get net cash flow. And then you also have things like opening balance and closing balance. Okay. Opening balance means how much money did you have from the last month. Closing balance means how much money do you have right now, how much money you're left with at the present situation. So if you have these five simple things, you can easily construct a cash flow forecast, right? So you need inflows, your earnings. It may be your job earnings, it may be your business, it may be a loan from the bank, it may be by selling your asset. Okay. Um, it may be an investment from an investor, money that you are gaining, money that's coming into your business. That is inflows. Outflows is your expenses. Expenses can be of different types, right? Examples are you may buy equipments, you may buy stationaries, you may buy furnitures. So there's no end to expenses. And when you minus your inflow with your outflow, that's your net cash flow. Okay, so the formula for net cash flow is CI minus CO, which is inflow minus outflow. And as I told you in the earlier picture, in the earlier slide, your inflow always needs to be greater than your outflow. If you look here, February, the total inflow was 10,000. The outflow was 9,000. Of course, less than the inflow. So there's a positive cash flow of 1,000. Okay, so yeah, and when you add 1,000 with your closing balance is 2,750. How did you get 2,750? You got 2,750 from the previous month. Okay, so from the previous month you will have a closing balance. When you take it to the next month, it becomes your opening balance. Okay, so when you add 2,750 with 1,000, it becomes 3,750. Now 3,750 for March will become an opening balance. So this is the closing balance. But when you go to next month, March, your closing balance will become an opening balance. Okay, so these are the things that you are supposed to know. Okay, so there you go. So it has 5 sections: inflows, outflows. When you minus them, you get net cash flow. Your inflow should always be greater than your outflow. If it is negative, that means you have to do something to make it positive. It's a red signal. Okay, and you have to find solution to solve that problem. Okay, opening balance is something that you have from previous month. So 2,750 from month of February, right? From the month of January, and then when you add your net cash flow, you get closing balance, and that closing balance becomes an opening balance in the next month. Okay, it's that simple. So this is how you construct. And one more thing, if you see your inflows, the list of inflows will always be less. Okay, and outflows, there'll be a lot of, because in businesses you have a lot of expenses, so this list is always going to be greater. So do not be overwhelmed. Do not be scared if your expenses list goes on, because that's how it is, right? If you have any questions, please do not hesitate to comment down on the comment section. We will take your question. I hope you can see the slides clearly. I hope the sound is clear. If there's any problem, just comment down. Right, let's go ahead. So constructing a cash flow forecast is very easy. You need 3 things: inflows, outflows, and closing balance. There we go. Inflows, outflows, and when you minus them, you get net cash flow. And when you add net cash flow with your opening balance, you get your closing balance. 2,750 plus 1,000, 3,750. Now you may question me, how did you get 2,750 from the previous month? From the previous month's closing balance, that will become your opening balance for the month of February. That's how it is, right? So cash inflows means your earnings. Your earnings can be, let's say you have a job and you get salary of 50,000 taka. That's your earning. Let's say you have a business and you earn 20,000 taka from there. That's your earning. Let's say an investor, let's say you are interested to invest in my business. 50,000 taka. That's an earning as well. Okay. I can sell this phone. This phone is not needed. It's not required anymore. So I can sell my business asset. When I sell this phone, I'll get 20,000 taka or 50,000 taka. And that's my earning as well. I can get a loan from the bank. That's an earning as well. Yes, I have to give it back with interest, but money is coming in. So any kind of money that is that is going to inject, that will be injected in your business, is your cash inflow, any money that is coming in. On the contrary, cash. If you look at this chart, for the month of January, the inflow was 12,500. For the month of February, it was 10,000. It dipped down a little bit. For the month of March, it was 10,000. April, May, June, it was the same. For the month of January, it went up a little bit. And accounts tells you a lot. You can go back and say, okay, why was it more in this month? What did we do right? Or was it any seasonal factor? Or was there any problem with our competitors? Anything. You can go and check those. On the contrary, outflows means the money that is going out. Outflow means expenses. Let's say you're earning 1 lakh taka per month, and then you have expenses. You have to pay your rent 10,000. You have to pay salaries of 20,000. You have to pay your insurance. It may be other expenses, buying furnitures. Okay, repayment to banks. Let's say you've taken a loan and you have to give money to banks. You have to pay your bills, water bill, gas bill. Any money that is going out is your cash outflows. And I feel your outflows must be lesser than your earning. Okay. Examples of outflows are given here. Subcontract labor, marketing. You've spent on marketing. It may be legal and accounting. For January, they've spent 1250 on lawyers and accounting. They have spent $2,500 for equipment. Salaries they've spent 1,000, and other costs 500. Okay, and you will see the list of outflows will always be greater. Okay, so that is your outflow, money which is going out of your business. And there are some payments which will always be fixed because you will know it from before, like rent. You know that every month you have to pay 50,000 taka rent. You know that you have to pay salaries for 30,000 taka. That'll remain the same. It'll be fixed, right? You do have to pay your electricity bill every month, gas bill every month. So from your expenses, there will be 5-6 expenses which will always be there, no matter what, fixed. Okay. So that's your cash outflows. Okay. And closing balance is the section at the bottom here. Okay, how much money you're left with, and this is so important. Okay, so when you minus 10,000 from 9,000 in the month of February, you get 1,000, and you have some money left from previous month. 2,750 was left from January. So when you add that, at the end of the month, you have $3,750, and this is good, because this is positive. It may be less, but it's positive. And it's good because last month you had 2,750. This month you have 3,750. So this is good. And you should be happy, positive. If it is negative, then that's the problem. Okay, so you have to go and see why there is a negative. Okay. So it's always good to have more money at the end of the month, and that is your closing balance. Okay, so the money that you're left with at the end of the month, right? So cash flow forecast. So today's chapter is about cash flow forecast, and cash flow forecast is very important. In research, it has been seen that 20% of the business fails because poor cash flow. Even if you make less profit, that's fine, but make sure that money comes in a lot and you spend less. Okay, because you should have enough money to pay your bills, to pay your staff wages, and forecasting is good. As I said in the beginning of the lecture, because when you forecast, it helps you to plan ahead. Okay. Let's say, for example, let's have a look. Okay, in the month of April we are going to have a negative cash flow. We're not going to have a negative closing balance, but your inflows will be lesser than outflows. Inflow is 10,000, outflow is 11,500. When you minus them, it's minus 1,500. So go and check out, why is it going to be minus 1,500? Can you do something to turn this situation around? Can you do something to make this positive? Can you do something, to avoid the situation? But you have enough money in your hand, so this minus will become positive. But what if you didn't have enough money in your hand? Then it would be a problem. These are your savings, right? So go and find out, why are you going to have a negative cash flow of $1,500 in the month of April, next year, because this is a forecast. So find it out and see if you can do something to turn the situation around. Okay. Yeah, let's go ahead. That's that. Um, yeah, we've talked about this. So you'll have net cash flow, opening balance, closing balance. These are also important. Okay. I've shown you what is net cash flow. I've showed you opening balance. I've also showed you closing balance. Net cash flow, you minus it, inflow and outflow. Opening balance will come from the previous month, money that you already have when you start a business. Closing balance is the money that you have when the month ends. Okay. So there you go. And some examples are here. So the formula of net cash flow, again I'm repeating, is total cash inflow, your earnings minus your expenses, minus total cash outflow. Let's say $150,000 is your inflow and $120,000 is your outflow. When you minus it, you have a positive cash flow, and this is good. Okay. But on the other hand, let's say your inflow is 230,000, but your outflow is 250,000. You'll have a negative of $20,000. This is worrisome. So you should go back and see, why are you going to have a negative balance at that period of time. So negative means more cash has flowed out than the business has earned. So you want to avoid that situation, right? Okay. So opening balance means when you start your business every month, you will have a money left with you. That's your opening balance from the previous month. Let's say if you start your month in February, you'll have something from January, let's say $1,000. So your opening balance for February will be $1,000, okay, coming from previous month. Yeah, and if you did, let's say in the previous month, if you don't have any money, then your opening balance will be zero. And closing balance is the money that you expect to have at the end of the month. Okay. So there we go. And the formula for closing balance is net cash flow plus opening balance. Okay. I'll show it to you again if you don't get it, so that's fine. We have plenty of materials coming up. So yeah. So there you go again. So we have one more example, cash flow forecast for Fissions Limited. And the ones that have marked in black, these are all inflows from January to December. These are all inflows, okay? And these ones are all marked in black. These are outflows. So again, it has proper three sections: inflows, outflows, and net cash flow. When you minus 451 minus 361, this is your net cash flow. It's positive 86. Opening balance was from the last month, let's say December. Okay. And when you add them, closing balance, how to find closing balance? Net cash flow plus opening balance, you get 97,000. Okay. So that's how it happens. Yeah, there we go. This is a cash flow forecast. Again, same. You have cash inflows, cash outflows, net cash flow, opening balance, closing balance, right? So then closing balance for January was 97, and then that became an opening balance for February. Okay. Closing balance for February is 51. That became an opening balance for March. So it goes like that. So as you can see, for the month of January, they have done quite well. Inflow was more than the outflow. 451 minus 365, 86. Okay. And opening balance from previous month was 11. You add that up, you have $97,000 for month of January. So that is good. That is positive. Okay. However, for the month of February, your inflow was 360, outflow was 406. So outflow was much greater. They had a negative cash flow of $46,000, or they're going to have a negative balance of $46,000. So when you do the math, you still have positive money, which is 97. Okay. And when you again do the math, you have closing balance of 51. So it's positive because you had enough money from the previous month. So this is quite worrisome. Why do you spend more in the month of February? It can be because, let's say, you had some important things to do. Let's say you had 10 computers to buy, you had to install something, or the business was not good because it was not seasonal. Or let's say a competitor has launched a very good product. It may be because of several reasons. So go and check it out. Okay. So this is negative, and your opening balance from the last month was 97 from January. You take that, and when you minus this, it's 51. It's still positive. At the end of February, it's still positive because you had enough money from January. So that has saved you. But that doesn't mean you will sleep peacefully. You should go back and check, because this reserve may get lower. Okay, this is your saving. This is a reserve. Again, for the month of March, inflow was less, outflow is more. Now, this is worrisome. Negative is 90. Negative cash flow, $92,000. Opening balance from last month is 51. Now, you're left with minus $41,000. You have to pay it from your own pocket. This is worrisome. This is really bad. Okay. Then, however, your inflow is a little bit greater than outflow for the month of April. Okay. And it has, with the opening balance and with this, deducting everything, you have $26,000. So your deficit has gone down. It was 41,000. It was minus $41,000 in the last month. But this month, since you've made a bit of business, it's $26,000 minus. However, again, month of May seems good. You've done quite a lot of business, 490,000. Expenses was 377. So that has reduced. And at the end of May, you have positive cash, $87,000. Okay, so that's how it continues, and that's how it'll go. These are all negatives. So look at the negatives and see, because you're forecasting. This is a future accounting material. You're forecasting for the future. So look at this negative and say, okay, what can I do to prevent this situation so that it doesn't happen in the future? Go and check it out. Okay. For example, this was negative, and then the owners decided to invest $300,000 on their own in the month of September, and that made everything positive, because they looked at their forecast and they've seen that they're not going to do well for that year, or for a lot of months, and that's why they have invested fresh new capital, fresh money. In September, capital introduced. Probably they have introduced a new investor, or they have invested their own money, and then the business became a lot positive. And it happens sometimes when business is not doing well, owners will put in their own money to make everything positive. And you can see they have a lot of money, 184,000 and 174,000, 180,000, 172,000. এটা না করলেও হতো, এটা না করলেও they would have been in a comfortable position, right? But they decided to introduce, and they made everything positive. So this is cash flow forecast. Every month, the money, the calculation will fluctuate, and if you prepare an account in advance, it will help you to understand and plan ahead for the bad months. In particular, with this example, the bad months for this company is March, April, June, um, and August. These are negative cash flow. So you can do something to prevent this situation. Okay. Um, so yeah, there you go. So yeah, today we have finished. Today we'll do till here. I think we have talked about a lot of things, a lot of numbers. I think this is enough. So this is basically cash flow forecast, right? It's quite easy. You need inflows, how much money coming in. You need outflows, money going out. When you minus them, you get net cash flow. Remember that your inflow should be greater. If it's not greater, then it'll be negative, like these months. Okay. And then you have an opening balance, money which is left from the previous month. For February, 97 came from here. Closing balance of January was 97. And this is carried forward in the month of February. And this will be your opening balance. There you go. Okay. And then at the end of February, you have 51. 51 means $51,000. You have $51,000 extra with your in your business, and that's always good, and that will go forward towards the next month. Okay, that is the reserve saving that will help you if your business is not doing well, right? So that's how it goes on. Okay. Before just going, we'll look at the formula of closing balance. It's net cash flow plus opening balance is your closing balance. And if you want to find your net cash flow, then total cash inflows minus total cash outflows. That's it. So I hope you've enjoyed this lesson. We've talked about these things a lot. I've showed you different examples. If you have any questions, do not hesitate to comment down on the comment section. Smriti Gomes has commented, very important chapter. Yes, very important chapter. And hopefully I was able to explain you in a very simple way, because sometimes with accounting, what happens, everybody makes it really complicated. And when I was a student, I used to hate accounting because everybody presented to me as a very complicated subject. But it is not. It's very interesting when you break things up, right? So go through it. You can replay again and again on our Facebook channel and see. And if you have any problem, if you didn't understand, just let us know. That will help us to make our teaching techniques and tactics better. Thank you very much. If you haven't liked our page, I would request you to like our Facebook page. It's very easy. It'll take just 20 seconds. Just like it. Subscribe to our YouTube channel. We're constantly uploading videos. We have around 40 videos now. We started the channel during pandemic, and we already have 40 videos. So subscribe it. Thank you very much. I will see you in the next one. I'll see you tomorrow, and we'll finish this chapter. Enjoy your weekend. Bye-bye.